The oil market, very critical, of course, to telling us which direction the global economy is heading. And in late February, a corner of the oil market, not the nominal headline price that we all see, but kind of some part in the shadow that we don't usually read about in our financial press, peaked and has been turning the wrong way ever since. And Jeff, you're going to help us understand and learn what is happening in the oil market and what it might mean or suggest about the direction of the global economy. The article you wrote, we're going to go over two of them. The first one is posted on the 18th of March, and it's called OK NYMEX, Go On, and it's at Alhambra Investments. And on that particular day, Jeff, you were talking about the front month of WTI, West Texas Intermediate Futures, and that they had plummeted just under 8%. And you brought up something called Contango. So help us understand, what were you looking at?
Well, as I say often, not just about the crude future, the WTI futures curve, but many money curves and yield curve itself, it's as important as nominal levels are. Often the curve shape is more important, or it's something you should focus on and be aware of. And in the crude oil market or the energy market, what we want to see with a balanced market or a reflationary market move that's a sustainably reflationary market, we would like to see the crude oil, the futures curve for crude oil be in backwardation, which is that the nearer term contracts are trading at a higher price than contracts further out into the future, because that's a disincentive for economic participants, real economic participants, including speculators, to store oil. We want oil to be flowing, continuously flowing into an economy because it's healthy, it's moving, it's robust, it's growing, it's full of life and energy and activity. And therefore it requires a lot of oil to be pulled out of the ground, transit through pipelines, maybe temporarily stored, and then moved right into the real economy through refineries, distillates, and all those other things. So we want to see backwardation in the crude curve because that suggests a healthy balance between all three of the factors that are really intersecting at oil. It's not just physical supply and physical demand, but also money demand and money supply. So you have money, supply, physical demand, all these things coming at us and working out into what we hope to be a nice downward sloping, very steeply downward sloping backwardation in the futures curve.
And you show on this article, you show us a nice graph that shows this transformation from late last year into more recent weeks and months, the transformation from Contango, which is the opposite of what we were just describing, where the market says, don't bring us any oil, okay, store it, we don't need it right now, to backwardation. And it's while at the same time moving up in nominal price. But in this article you mentioned, there's a little bit of a quirk in that very first front month. What's going on there? It seems to be turning the wrong way. Contango, it's saying, don't bring us oil right away. Wait a month.
Yeah, that's, I mean, from January forward, really, January and most of February, that was the reflect. I mean, not oil prices all over the curve were moving higher, but they were moving the highest or the fastest and the farthest at the front end, which really steepened the backwardation, which, I mean, that's a beautiful thing. That's a positive, optimistic. We think the oil part of the economy is looking really good and healthy kind of a thing. But then in late February, we started to see the curve change shape a little bit, which was, first of all, while it was still rising, oil prices were still rising nominally, the entire curve was shifting nominally. It wasn't shifting nominally, it wasn't shifting higher in the same way it had before. Some of that backwardation started to get moved out. And then at the very front of the curve, between the first and second month contract, so the front month contract and the 1 month further down the road, it started to flatten out and even come into a little bit of a couple pennies worth of contango, which by itself is, it's not earth shattering. It's not a huge deal, but it's enough, and it's odd enough that you see, when you see something like that, you think, okay, this is something we should pay attention to. Is the curve shape is something happening in the crude oil market that's potentially shifting perceptions, at least at the short run, that could then become something more than that, where we see things move at the long run and maybe even go even further than that. And what that front month contango, it could be a couple different things. It could just be, as that front month heads toward expiration, it becomes less and less liquid, and there's some technical issues there. And so it was interesting to see the Contango survive I believe it was the April contract going off the board, and now the May contract is the front month. And yet that front month Contango, it's not there today, but it has been there up until today. It's been a couple pennies too. So flattening out at the front month, is that just maybe, is there technical issues there? Or is the entire crude curve starting to suggest looking at the world very differently than it had been in January and February?
And then you came back to the issue. You wrote about that on the 18th. Then on the 23rd, 5 days later, you came back to it, a new article. Okay, NYMEX, beginning to notice the fine print. And there you talk about that maybe there was a technical factor in the front month there with the April contract expiring. But what you said is what really got your attention is that now the backwardation was evaporating, just how fast it was being drained out of the whole curve. And you were concerned that that might be telling us something.
Yeah, so we went past just the front month Contango, which was as the April contract went off the board earlier this week on Monday. Now we have the May contract in the front, and yes, it was lower than the price of the June contract. So the Contango, first of all, that front month Contango survived the shift in front month contracts. But over those, really it was those couple of days where oil was down big, what we'd seen is that it was down huge at the front, which was the opposite of what had happened in January and February, where it was up big at the front, which steepened the backwardation. So the opposite of steepening backwardation is flattening, not into Contango, but toward Contango. And the level was really pretty severe, because if you looked at, I think it was the calendar spread out to December, it was cut by more than half, from $4 and something down less than $2. And that was just in the space of a week. And if you looked at the calendar spread out to the June 2022 contract, it was even more. It was from like $7, which was, again, beautifully steep backwardation, down to less than $4, which is, you have to wonder what is going on in the oil market. What is NYMEX trying to tell us? Now, it could be this is just a short-term fluctuation. I mean, profit taking after an enormous run-up in oil prices wouldn't be out of line at all. It wouldn't be out of character. But with these kinds of different changes or twisting and shapes of the curve, it seems like there's potential for a more robust and maybe even more meaningful shift in the oil market.
And you bring up a couple of items in this article here that suggest to you maybe there's more to it, because it's not just the oil market in the 24th and the 25th, but New Zealand's currency, the Chinese currency, the activity index that was being reported out of Chicago. There are some economic and financial markers that all seem to be inflecting around that time, corroborating what we're seeing in oil.
There's also, the bigger picture too. What was largely behind the run-up in oil prices was essentially a promise of a much better future. It wasn't present tense, it was always future tense, right? The combination of vaccines plus government largesse was going to contribute to a pathway toward normalcy. We didn't see it in the data, certainly in January and February. In fact, it was the exact opposite. As you just referenced, the Chicago Fed National Activity Index plummeted down to minus 1.09 in February, which is deeply recessionary. That's a deep recessionary signal. That's not, it was blamed on cold weather in Texas and all that kind of the power disruptions and things there, but you don't see minus 1.09 due to cold weather. So there's concerns about today that are not being completely erased by vaccines and government spending. And I think that's really the point here. Over the last week or so, the latest government helicopter drop has taken place. That money is already hitting the economy, so at least it's supposedly hitting the economy. And here you have a lot of signals around the world, all this promise of good things to come, and yet there's still enormous doubts as to whether or not these things will actually end up contributing in the way that they're supposed to. And so maybe that's what the oil curve looking out is signaling. We start to look forward 5, 6, 7 months, maybe into next year, and the backwardation starts to slide toward Contango. You think, is the oil market starting to reevaluate the promise of vaccines and stimulus and say, I'm not as reassured as I was a couple weeks ago?
Jeff, is there anything that we didn't cover in these oil market focused articles that you wanted to bring up before we move on to part 3 of the show?
The review is really about curve shape, because there's so much that we can learn from the shape of the, contango and backwardation and commodity curves, and then steepness and inversion and other types of curve. We talked about before the TIPS curve, which is inverted in its own way, which is that inflation expectations are far higher in the short run, consistent with that run up in oil prices and copper and other things that have gone higher over the last couple of months. But yet you go further out in time, the market is saying we're not so sure that short run inflationary constraints and pressures are going to last all that long or leave much of an impact on the long run. In fact, you get to the furthest out in inflation expectations, the long run five-year forward rate, it has barely moved much at all over the last couple of months, which is the market saying we see all of these positives, vaccines, government spending, QE to the moon, all these things around the world, and we're not convinced it's actually going to change anything from the long run trajectory, which up until last year hadn't been very good at all. So as we talked about with the Paul Krugman article, once we get past all this government stuff and COVID and vaccines, what does the world actually look like in late 2021 or going into 2022? And we have all of these market signals that had been very positive, now starting to look at reevaluate potentially and say, maybe it's not as good as positive and perfect as we had hoped.
And we can look to Japan with our review of the last 20 years of QE. The market's looking to this experiment having been perpetrated and perpetuated worldwide over and over, and the same results. So that's why we're not expecting more than a mild reflation, I would expect. Well, Jeff, thank you very much. Let's move on to part 3.